Hello, everyone, and welcome to episode 3 of the Lifespan Investment Series. And a happy new year, given that we're almost towards the end of January now. I hope you all had a great festive period. And a special welcome and happy new year to Jonathan Payne. Welcome back, JP, for a massive 2024. Um, I think the way last year panned out has set up for quite a big year this year. I'm sure you agree.
Yes, I do.
Absolutely. So very much looking forward to see how things pan out this year. Late 2023 showed signs of inflation easing across most of the world and in the US in particular. Do you see this continuing throughout 2024?
Well, thank you, Eugene. And yes, Happy New Year to everyone. My goodness me, here we are, a new year, and so much to look forward to. 2023 was a fascinating year, and I have no doubt, Eugene, that 2024 will be equally as fascinating, if not enthralling. So, your first question with regard to inflation, yeah, that was a key story for 2023. We saw a deceleration in the rate of inflation pretty much across the world, in the United States, across the Eurozone. In fact, in China, Eugene, as you know very well, we've actually got outright deflation, both at consumer price level and at the producer price level. And perhaps we might even touch upon some of that later in our conversation. In terms of the trends for inflation in 2024, I think we'll continue to see an easing in the headline rates of inflation. We've seen, energy prices being so much better behaved. Also, food prices critically, we're seeing a deceleration there. And in the United States, as you know, a significant part of inflation is, of course, shelter inflation, housing inflation, which comprises about 1/3 of the overall consumer price index in the United States. And we're seeing a deceleration in that. As you recall, Eugene, in 21 and 22 in particular, it was that very sharp rise in shelter inflation that served to elevate overall inflation. So the core thrust of the outlook for inflation is a continued deceleration. Of course, all eyes on that magic number, 2%. That central banks around the world generally try and achieve or highlight as their target rate. I think getting down to 2% is going to be a little bit tricky because we still have some fairly sticky service-based inflation, which is being somewhat stubborn. And also, of course, right across much of the developed world, Eugene, we are seeing some upward pressure on wages. So I think the journey to 2% is going to be a rather challenging one. But at the end of the day, that big inflation shock that we saw a few years ago now, I think is in pretty much the rearview mirror.
Yeah, no, I think we all agree that inflation has rolled over. It seems to be a bit stickier though in Australia. So I want to hear from you about that as to why perhaps some commentators would suggest that it might take a little bit longer in Australia to get inflation back to that magical 2 or 2.5% level, and perhaps what that means for interest rates. And then if we move through inflation, because why we're really so interested in, or a major reason as to why we're so interested in inflation is to see how that impacts on interest rates. So I want to talk about what you think we're going to see in 2024 in terms of interest rate cuts. Hopefully, I think everybody's hoping for interest rate cuts and no more increases. I think general consensus, well, reserve banks seem to be talking about 2 to 3 in Australia, 5 to 6 in the US. That sounds a bit optimistic to me. So can we hear your thoughts about some of those aspects?
Yeah, this is such a critical area, is it not? Hopefully we can now breathe a bit of a sigh of relief that we've seen the worst of it in terms of interest rate hikes across most of the world's major central banks. If I may, I'd like to start with the United States. Clearly, at the end of last year, the market got very, very excited and started pricing a so-called Powell pivot, and the expectation that the first rate cut by the United States Central Bank would come in March, and that the market was also, by the end of last year, pricing approximately 6 cuts in the key federal funds rate. I feel right now that the US central bank is going to be a little bit more timid than perhaps the market is expecting. I don't think we'll necessarily get the first rate cut in March. However, I do see a significant series of interest rate cuts by the US central bank in 2023. And the other thing that really complicates the monetary policy calculus, Eugene, is of course the political calendar, and I do want to spend a few minutes later in our discussion on the US election, which is obviously November 2024. But ultimately, I do see the key federal funds rate coming down. Is it going to be 4 or 5 rate cuts? Let's kind of wait and see. And I'm happy to be data dependent because, of course, the US central bank is. In terms of the Eurozone, again, the market is pricing several cuts by the ECB. However, at the very recent World Economic Forum meeting in Davos, a number of ECB governing council members spoke either on panels or in actual formal addresses, and they pushed back on the market narrative of significant rate cuts and then coming early. So I think both the ECB and the Fed are going to be somewhat cautious, somewhat timid, and kind of wait until perhaps the second quarter to really start cutting rates. Let's talk about the Reserve Bank of Australia. I think you're right. I think the Reserve Bank will be one of the more timid of the central banks. Our inflation is higher and proving to be somewhat more sticky than it is in the United States and also in the Eurozone. And obviously, don't forget, we've got a new governor at the Reserve Bank of Australia, Michelle Bullock. And I think, when you're settling into a job, you're probably going to be a little bit more cautious. Obviously, the RBA raised rates, which disappointed the Australian government, which I think foolishly have kind of implied that the Reserve Bank didn't need to raise rates any further. I think that painted the new governor into a bit of a corner because Michelle Bullock had to kind of demonstrate her autonomy and independence from the political machine, from the government. So inflation here in Australia is probably going to be higher than what we're going to see in the Eurozone and the United States. I think there's several factors going on here in Australia. First and foremost, we have this massive surge of immigration into Australia in 2023. And I don't know if you've got any numbers, but it could have been by the end of the year about 750,000 new arrivals, which is a really significant number in the context of a relatively small population. So, when you arrive in a new country, and as I did to Australia in 1997, you have to go out and buy carpets and sofas and fridges and microwaves. And I think that really was a big stimulant to the economy in 2023, notwithstanding the very sharp rise in interest rates. And then on the energy front, all of us, whenever I look at the energy bill, the electricity bill, the price of gas, the price of electricity, everything seems to still be kind of moving upwards. So there are some stickiness in terms of utility prices. Wage inflation here as well. I mean, our labor market is really, really very tight. And you continue to see just walking around help wanted signs. And I know that the very latest employment report in Australia saw a stunning decline in full-time workers. I actually challenged that data. I think the Australian Bureau of Statistics has got a problem with its employment model. But the bottom line is wage inflation here is certainly has been moving upwards. So I think the Reserve Bank is going to be very, very cognizant of that and actually going to be relatively conservative in terms of the rate cutting cycle, and will certainly wait until the US central bank and other major central banks have actually started cutting rates. We, I think, will be the last cab off the rank when it comes to rate cuts, Eugene.
Yeah, no, I would agree with that. And I think, central banks around the world do have in the back of their minds, the 70s. They're trying to balance this issue of trying to stimulate the economy, but also they don't want inflation to come back. They want it dealt with. They want it back in its box. So it's going to be interesting to see whether they've got the courage to actually cut rates, particularly if inflation isn't right back down to the level that they want it to get to. So that'll be an interesting dynamic that'll play out this year, I think, across the world. But yeah, Australia is certainly an interesting one with those levels of immigration. That certainly is inflationary. And look, I think without dwelling on this too much, because I want to talk to you about recession as well. Australia has been in a per capita recession now, probably for 3 quarters, I would say. The only thing that's kept us out of an actual recession is immigration. I think we can probably all agree on that. So it'll be interesting to see, whether those immigration levels are going to continue, and whether or not it's enough to keep us out of a recession in 2024. So let's talk about the recession, because obviously that's going to have an impact on equity markets and lots of other markets. It'll also have an impact on when rates get cut, you would think, and how aggressively they're cut. So what do you think? Talk us through which of the major countries around the world are already in a recession, and what you expect in terms of the likelihood of a recession in Australia, the US, 2 countries that have avoided recession so far, and any others that you think are notable, JP?
Yeah, this is important, and I just want to emphasize to everyone listening, and certainly those of you that read my weekly pain report, you'll know that my forecast in the United States for 2023 was that there would be a recession in the year of 2023 in the United States. And obviously that didn't happen. I can't dwell too long on all the reasons I got that wrong, but one of them would obviously be that I once again underestimated the resilience of the shop till you drop American consumer. And by the way, I've made that mistake before in my 40 years in the financial markets. I just can't help myself. I always underestimate the strength and resilience of the American consumer. But obviously the American consumer came through 2023, spending strongly. And that was one of the key locomotives for growth in 23. And the other aspect was, of course, the significant continued fiscal stimulus that we saw through 2023. I think that's going to move from being a tailwind to a headwind in 24. Government spending is not going to continue at the same rate. And I think the American consumer now, and we can see it in the savings data, has basically spent a much or almost all of that excess savings that built up in that post-pandemic period. So I'm afraid to say, and I've got to say it, I've got to be faithful to what I believe. In 2024, I think we will see a recession in the United States of America, predicated upon the long and variable lags and impact of monetary policy, which Milton Friedman used to articulate. And I think it's a matter of time before that sharp rise in interest rates begins to filter through into the US economy. I will very much concede that the housing market in the United States, because of the 30-year fixed rate mortgage phenomenon, much of the household sector was relatively immune because, of course, they locked in those 30-year fixed rate mortgages that are between 2 to 3% in the years 2020, 21. But even having said that, we're seeing continued evidence that smaller companies in the United States are finding it increasingly challenging to get access to credit, and that banks, community banks, regional banks, and don't forget that there are over 4,000 banks in the United States, they are tightening their lending standards, and we're beginning to see an outright contraction in bank credit. Every single time that's happened in the last 50 to 60 years, that has led to significantly weaker economic growth. So I do believe that it is a matter of time before we see a recession in the United States. And I concede I was wrong in 2023. So I'm afraid I'm going to have to be faithful to what I see as the laws of economics. And I've said to you, Eugene, privately, that if I'm wrong about my recession call in 2024, I will burn all my economic textbooks, and I will find a very nice, quiet place to hibernate. Now, the Eurozone,
All
obviously.
heard it.
Sorry, Eugene.
I said to the audience, you all heard it.
Anyway, Eurozone. Obviously, there I had a little bit more accuracy in terms of forecasting, because I said that the Eurozone would be in recession by the end of 23, and effectively we are in recession across the broader Eurozone. The weakest link in Europe is uncharacteristically Germany. And in fact, what's happening in Germany is really quite significant. I mean, some commentators are referring to the deindustrialization of Germany. And all of you will know the car companies in Germany are struggling. The Chinese EV makers such as BYD are dominating the market. In fact, China, just as a quick anecdote, ended 2023 as the largest car exporter in the world, which is dramatic, because 3 years ago they were virtually nowhere. So that's a story to keep an eye on. But suffice to say, I'm afraid many companies across the manufacturing sector in Germany are getting really hit very, very hard. Rising costs, declining sales, particularly to one of their largest export market, which is China, being hit by the tsunami of Chinese electric vehicles. And I'm afraid business confidence, consumer confidence in Germany is very, very poor. Across the broader European economies, I'm afraid they're flat on their back right now. And 2024, I don't see a meaningful change. If I dig down into the European Central Bank lending surveys, European banks are tightening their belts, are shrinking their balance sheets, are lending less. And in fact, the ECB themselves, in their monetary policy statement, are highlighting the contraction in credit to businesses and also to households. And of course, as with the United States, the impact of that sharp rise in interest rates by the ECB is still filtering through into the economy. So I'm afraid Eurozone is in a relatively poor state. Let's go briefly now, if I may. I'll comment about the UK, even though, of course, they left the European Union in 2016, as you all know. UK is also very anemic in terms of growth, pretty much around the zero line. And I'm afraid 2024 possibly isn't going to be that much different. I'm seeing also a very large rise in corporate bankruptcies in the United Kingdom. As you know, I have a lot of interesting contacts within the UK, and I'm afraid all of them on the economic side are saying things are pretty flat in terms of the UK economy. Let's go briefly to China. Look, a quick caveat here. Hopefully, some of you listening to this will know that if you go back to 2003, my goodness me, what's that, more than 20 years ago, I was arguably one of the most vocal bulls on China, the rise of China, and the significance of that for Australia and the broader global economy. I'm afraid those days are well behind us now. China faces some massive, massive headwinds. The demographic headwinds are extraordinary, so that we now have a so-called negative birth rate in China. I saw some alarming data just a few days ago that they had the fewest number of births in China since 1957. And you think that's a population of 1.4 billion today. Then, of course, you've got the debt profile, particularly the weakness in the property market. So I'm going to say this, and I'm sure this will get out into some kind of public domain. I'm afraid I don't believe the Chinese economic statistics anymore. I do a lot of work on the Chinese economy, and I do not believe the Chinese economy is growing around 5%. I think the real growth rate could be somewhere between 2 to 3%. As commented earlier, China is actually in deflation. We're actually getting a net absolute decline on a year-on-year rate in both consumer prices and also producer prices. I think one of the only ways China has out of this a period of economic stagnation is, of course, through the export channel. And that's one of the reasons why we're going to continue to see a flood of Chinese electric vehicles into the global automobile market. Furthermore, the authorities in Beijing seem reticent to provide any kind of significant stimulus into the economy, the likes of which we saw, of course, in the great crash and the financial crisis of 2008 into 2009. Xi Jinping, the president of China, is very reluctant to kind of add to the debt burden that China already suffers under. So ultimately, I'm afraid China is no longer the kind of primary locomotive of the global economy. In fact, I see weakness in the Chinese economy over the next several years. Now, let's turn our attention closer to home. Australia, I find really difficult to call right now. We've already mentioned this extraordinary intake of migrants in 2023, 750,000 or thereabouts. The numbers are going to roll over, obviously, slightly into 24 and into 25. We here in Australia have, of course, a housing market that is much more sensitive to higher short-term rates because the majority of our mortgages are of a variable rate nature. So we've got a lot of headwinds as we get into 2024. Furthermore, of course, we've got the weakness from our largest trading partner in China. Eugene, you said it earlier, we are and have been experiencing a per capita recession, but of course, the actual GDP numbers reflect, of course, that surge in population. I see the Australian economy kind of relatively weak in 2024, and on occasion we might even kind of flirt with an actual technical recession, which is defined, as you know, as 2 consecutive negative quarters of GDP. I'm not overly excited about the growth prospects in 24, but at the same time, you know, Australia has so many attractions going for it, and hence why, you know, 750,000 people chose to make Australia their home in 2023. So big picture, longer term, I remain optimistic about Australia, our way of life, because we have so many assets and certainly so many attributes. But I think 24 is going to be a relatively tricky, challenging year for the headline growth rate, GDP rate. And I don't envy the Reserve Bank of Australia navigating these conflicting economic and macroeconomic signals this year.
Absolutely. And without dwelling on it for too long, do we agree that when countries do go in a recession, that probably increases the probability of rate cuts and perhaps increases the intensity of rate cuts, because the idea of rate cuts is to try to offset the recession. So if we do go into recession, then I'd say the narrative around having a decent number of rate cuts is probably going to add to that. But if we don't go into a recession, either in the US and in Australia, it's probably harder for reserve banks and central banks to cut rates. Is that a fair?
Yeah, absolutely. I agree wholeheartely.
Yeah, there's other factors.
It's probably going to be more around mid-year when we get the kind of real picture on the kind of the GDP outlook. But you're absolutely right. I believe with inflation having moderated to the extent it has, the central banks will be quite aggressive in terms of their potentially accommodative monetary policy. And just one small caveat I just need to emphasize, and I know I'm trying to drag this conversation into a political one, because I think politics this year is really critical. But in the United States, I've been speaking to several people. Initially, I kind of dismissed their storyline, but as time has gone by, I'm more receptive to it, and I'm listening to it more closely. But there are quite a few people in the United States who are saying that Jerome Powell and the US Central Bank are going to do everything they can to keep Trump out of the White House. And this notion we have of this, independence and autonomy that the central bank is immune to politics. You will remember, Eugene, how Jerome Powell was the victim of numerous tweets from the former president of the United States, and Trump gave Powell a really hard time about interest rate policy. If you recall, he was actually asking Powell to take interest rates into negative territory, which is, of course, what was happening in Japan and Europe. But the bottom line is there is definitely an opinion, let me just say, in Wall Street, that if the greater the prospect of a Trump victory, that will start influencing US monetary policy. Now, I haven't gone public as to my agreement or disagreement with that narrative. The important thing is there's some interesting people in America who genuinely believe that the US central bank will not be autonomous or independent in 2024 because of the fear of a Trump presidency.
Yeah, right. That is interesting. And that's obviously one of the big events that's going to occur this year. Talk to us briefly about what you think the impact of the election will be on markets. At the moment, I think I've heard some say that if the election was today, Trump would probably win. That can obviously change quite dramatically between now and November. But yeah, what do you think? How do you think the election this year in the US is going to influence markets, apart from what you just said?
Well, as we are doing this interview, Eugene, we're just beginning to see some numbers coming in from New Hampshire. So obviously Donald Trump won Iowa, the Iowa caucus. He broke every single Republican record in Iowa. He won 98 out of 99 counties in the state of Iowa. And the county he lost by 1 vote. DeSantis has subsequently dropped out. So now it's Nikki Haley up against Donald Trump. My personal view is that the Trump train has left the station, destination the White House. If there was an election today, as I said in my weekend report, I think Donald Trump would win it. I believe one of the key issues for voters in the United States in 2024 is going to be immigration, illegal immigration across the southern border. And even if you like or dislike Trump, you're more likely to vote for Trump purely on the basis that the majority of Americans blame Biden for what is happening on the southern border. And the numbers of illegal immigrants coming in every day are breaking and smashing every single record. So the bottom line for me right now, we know what Trump is about. We've seen enough of him to know. His first priority is America first. What does that mean? Emphasis on national security, emphasis on the southern border and the security of the southern border. And he has said it very explicitly. He will come in as president and he will actually close the southern border. So there we have it. Now, obviously, other issues are the economy, and other aspects of social policy. But ultimately, right now, the polling shows that, like or dislike Donald Trump, they're more likely to vote for him because they're concerned about Joe Biden's age. And the majority of Americans, we know from polling, believe that Joe Biden is too old to be president of the United States of America. So there you have it. That's a kind of cold, calculated appraisal of the political scene. What does it mean for markets? Well, you said it yourself. We're January 2024, a long way from November. As we know, a week is a long time in politics. 11 months is an eternity. So, but again, let's just take a step back. What did Trump do in his first term? Massive fiscal stimulus, big tax cuts. Trump does not fear debt. So we know that he won't be more restrained in spending. And goodness me, I don't know how much it's going to cost to build that wall, which he constantly uses, says at all of his rallies. But there will be some form of wall, maybe it's an electric fence, constructed on the southern border, I believe, if Trump wins the White House. Now, in terms of the budget deficit, we know it's around 6% of GDP as we speak, and that's without a recession. Imagine what the budget deficit does if America goes into recession. Trump will not be conservative around his fiscal policy. So ultimately, all things being equal, a Trump presidency would possibly put upward pressure on bond yields because of the amount of Treasury issuance that would need to fund that very large budget deficit. However, as we go through 2024, I see the economy weakening, and that will then put downward pressure. But ultimately, the prospect of a Trump victory in November will engender quite a high degree of volatility as we get into that September, October period. And the other thing, there are elections in every corner of the world this year, but there's one election that affects every single person in every corner of this world, and that is the US election. So we have to talk about foreign policy. I believe a Trump presidency would be isolationist, it would be protectionist, and I do believe there'll be changes to the NATO alliance. I believe there'll be changes to the conduct of the war in Ukraine, and I also believe there'll be changes in terms of US policy as it pertains to Taiwan. As we know, for 40 years, this notion of so-called strategic ambiguity has been the kind of framework for cross-strait relations between China and Taiwan and US-China relations. I believe Donald Trump will not, certainly not, go to war with China over Taiwan, and I believe he will tell Xi Jinping that. And with regard to Ukraine, I think you'll see the United States pull back its support from Zelensky in Ukraine, and all of Trump's focus will be on national security, on his America First policy. And as we know, Eugene, Trump is transactional rather than ideological. And his ultimate ambition, his ultimate goal is to secure and safeguard the national security of the United States. So throw all that into the mix. What does it do to the geopolitical jigsaw puzzle? A Trump presidency would be transformative when it comes to the so-called geopolitical jigsaw puzzle. As I outlined, fundamental change in policy with regard to United States' role in Europe and NATO, fundamental change in US policy as it pertains to Taiwan as well. So I'll leave it there because, as you can see, I could talk about that forever.
Indeed. Yeah. So fascinating. Should be an interesting year. Let's turn to what we think is going to happen in equity markets this year, and then we'll talk a little bit about the portfolios. So JP, what are you thinking? Obviously, US markets just made an all-time high. Aussie markets are trading within, I don't know, 3 or 4% of their all-time high. Not so much other markets. Like if you look at, I was quoting the S&P 500, but obviously if you look at the Russell, which is a much broader index in the US, it's trading well below its all-time high. And there's a story there about just the fact that some of the very largest, 7 or so companies in the US have just done so incredibly well, and that's caused some of these major indexes to go up. But it's not necessarily the same for if you look more broadly across companies across broader indexes. So what's your outlook? Are you still bearish? You were quite bearish last year. You're still bearish for 2024? And then let's talk briefly about how the lifespan managed accounts are positioned.
Yeah, sure. Okay, so obviously in 2023, we saw a very late surge in the S&P 500 from that October lows into the end of the year. And just in the last few days, we actually finally eclipsed the previous all-time high in the S&P 500, which, as you know, was January the 4th, 2022. So it's actually been 2 years since that all-time high, and we've now surpassed that level just in the last, literally in the last several trading sessions. It's been a highly eventful 2 years. as you correctly highlight, the Russell 2000, of course, is way beneath its previous all-time highs. I think it's still down 20% from those levels. Now, the S&P 500, as we know, market cap weighted index, and therefore the larger the company, the greater the impact on the index level. And there's 7 companies which have now been described as the Magnificent Seven. I sometimes call them the 7 wonders of the world. And these are truly remarkable companies. And just a quick, tiny kind of tangent here. But when you think about the names that comprise that Magnificent Seven, whether it's a Microsoft, it's an Apple, it's a Tesla, Google, Amazon, NVIDIA, these are kind of household names, less so perhaps NVIDIA, but the rest are household names and just universally, recognized around the world, all of them with very, very strong balance sheets, perhaps slightly with the exception of Tesla. But the bottom line is that these have been the primary locomotive of the S&P 500. Now, just year to date is quite interesting, and we're nearly at the end of January. NVIDIA and Microsoft have, just those 2 stocks have accounted for something like 70 to 75% of the rise in the S&P 500 on a year-to-date basis, which is truly stunning. And as you know, Eugene, and for those of you who have the painful experience of reading my weekly pain report, you'll know that in the course of 2023, I finally got my head around the AI phenomenon, the transformative nature of artificial intelligence, and the company that really you have to own if you are a believer in AI, which I am, is NVIDIA. And NVIDIA obviously was the best performing company in the market in 2023. And then, of course, Microsoft is another name, if you believe in AI. And so both those companies I highlighted through 2023. Now, my challenge in 2023 was I was bearish on the economy, bearish on the overall index, but by May of 23, acknowledged this AI phenomenon. And as we get into 2024, am I still bullish on AI? Am I still bullish on NVIDIA, a company like that? Yes, I am. But at a broader level, we're going to see, I believe, equity markets struggle through the course of 24, because what we saw in 23 was almost exclusively price earnings multiple expansion. And if you look at earnings per share growth in calendar 2023, and I'm going to ask this question when I speak at investment conferences, I reckon if you asked 100 fund managers, what did earnings do in 2023? Not many of them would say 0. We haven't yet had all of the Q4 numbers yet, but it looks like for calendar year 2023, that S&P 500 earnings per share growth is around 0. It could be a -1, a +1, +2, but very close to the 0 line. And I think that might take people by surprise. Therefore, by definition, and by the virtue of arithmetic, if you have a 0 EPS number for growth in 2023, and you've got an index that's gone up a lot, we know that all of that is now as a consequence of price earnings multiple expansion. And that was what characterized the year of 2023. Now, I think price earnings multiples on the broader index are somewhat expensive. And I think most strategists would concur with that. So for the market to really move ahead in 24, you either need further multiple expansion, which I'm very doubtful over, or significant EPS growth. Now, the consensus expectation for S&P 500 calendar year 2024 earnings growth is around 10 to 12%. I would mark that nearer 5%. I'm not going to get catastrophic on an EPS projection. I'm battered and bruised after the mistakes I made in 2023. But I don't see that kind of EPS growth in 2024. So therefore, by definition, the valuation arithmetic tells me to be conservative. It tells me to be cautious into 2024. And I'm not going to throw into the mix the Middle East or anything else like that. One thing I have learned is whilst I might find geopolitical events fascinating, most of the time Wall Street ignores geopolitical events such as the Middle East until they actually can't ignore it anymore. But the bottom line for me is the US equity market in particular is looking pricey. I think that if you just look at the chart, if you look at the price earnings multiples, I think you'd have to agree with that. However, I am also acknowledging, as I have done in my reports for the last 7 months, that this AI thing is real, and we've got to identify the companies that are the primary beneficiaries of that new transformative revolution. And that's basically NVIDIA. Why? Because NVIDIA manufactures that extraordinary GPU or chip, the H100. And if you look at an outlook for revenues driven by their data center revenue growth, it's really quite attractive. What I'm trying to say is, if you looked at NVIDIA on a 2-year forward price earnings multiple, so assuming what the earnings are for the next 2 years, which I think we can have reasonably high degrees of confidence about, NVIDIA is not as expensive as some people say. And I think a company like NVIDIA and Microsoft will be able to generate reasonable earnings growth, but the broader market will, I think, disappoint on the EPS front.
Okay, so that's interesting. So despite being battered and bruised from last year, sounds like you're still bearish. It sounds like there's a sort of a perfect storm of things that could lead to a downside, in the sense that, you know, equity markets seem to be priced for perfection, 10 to 12% earnings growth, quite stretched P ratios. I would probably argue that the equity markets aren't pricing in a recession in the US, or if they are, a very shallow one. So if any of these, let's not forget quite a significant number of rate cuts. So if any of these issues do disappoint, that could lead to some significant volatility. So it sort of pays to be defensively positioned. Notwithstanding, it sounds as though some of these giant companies that have fared very well probably will continue to a certain extent. Notwithstanding, some of their valuations are a bit stretched as well. But you'd sort of have to look at each one individually. All right. So that being said, let's turn to our portfolios, and let's talk about, I think, before we talk about what we've done in the last sort of 3, 4, 5 months, because we've done a few things, and I'll hand it over to you, JP, to talk about that briefly in a minute. But I think 2024 is that year that, you know, if equity markets are going to fall apart to some extent, it'll probably be this year. I think a lot of us and a lot of others expected it to happen in 2023, but everything proved a bit more resilient. It took longer for some of the problems out there that could lead to an equity market rout to flow through. So I think 2024 is going to be that year where it's sort of, if it's going to happen, it's probably going to happen this year. And, you know, that's one of the difficult parts of trying to be tactical with a portfolio. Getting out's probably easier than getting back in a sense, you know. So that's going to be quite a challenging ride for us this year that we look forward to managing. But JP, do you want to talk us through some of the changes we've made over the last sort of 3 or 4 months?
Yeah, I think the key change was in the tactical portfolios, where the team basically closed or reduced some of the underweight to equities. You might all recall we actually had very sharp declines in equity markets from about July down to those lows in October, and the market was actually had become very oversold. If you look back at the charts and you look at any technical measure, the markets were very oversold. We're kind of forgotten how sharp that sell-off was. It was about a 12% decline, in fact, in the S&P 500, and the team at Lifespan took advantage of that and actually reduced the tactical underweight to equities in the portfolios, and that's been quite a beneficial move.
Yeah. So we did that. We probably went from being about 80% underweight down to about 60% underweight. So we just topped up our equity positions in the tactical side of the portfolios, and the idea of that is to slowly get back in. I mean, markets did fall quite sharply, but they didn't fall all that much. It was just sort of a very quick drop. So we thought, and our medium term view is still a bearish one. That's why we didn't, in a sense, buy more. But yeah, we took that opportunity, which has worked out okay. And we also shaved a little bit off our bond overweight, our duration overweight in the tactical portfolios. That's something we actually did in the last couple of weeks, given that long-term bond yields spiked or went up quite dramatically, and they had quite a dramatic fall as well. I think the 10-year bond went from 5% in the US to just under 4%, which is quite an extraordinary move. But we're still pretty optimistic on longer dated bonds because I think medium and longer term rates are going to come down. Well, at least that's our view. Anything else to add to that, JP?
Yeah, I just want to emphasize that move in bond yields between October and December, as you've just said, Eugene. I mean, I'm an old-fashioned bond guy, as you know. I started in London in 1984 and actually was managing global bond portfolios in 1984. We saw the 10-year note yield. You got it to the button, actually. It literally touched intraday 5% on the 10-year US Treasury note yield. And then it dropped down. I think it traded at 3.87. Right. And that's a 113 basis point move in a relatively short period of time. Now, as you know, obviously, everyone listening knows that the longer the duration of your bond, the greater the sensitivity to any given change in terms of the basis point change in yield. So just for very round numbers, if you've got a longer dated bond with a very long modified duration of 10, if you get 100%, 100 basis point decline, it's a 10% rise in price. So you saw a dramatic increase in prices at the longer end of bond markets around the world. It was a really quite a startling move in global bond markets. So the team did very well, actually, basically taking advantage. It's almost like a gift you couldn't ignore at year end with such a sharp decline in yields, sharp rise in bond prices.
So, all right, great. Well, look, thank you for that. We might leave it there. We've gone on for a while, but there's so much to talk about. Thanks for joining us again, JP, and thanks for everyone that listened in. And just keeping in mind, if you've got any questions about this or anything we've discussed, do contact your financial advisor, and they'll be more than happy to talk it through with you. So once again, all the best for 2024 and everything else, and we look forward to talking to you again soon. Thank you.
Thank you.